Welcome to This Week in Money. I'm Jim Goddard. Today, Martin Armstrong of Armstrong Economics believes the scary ride atop the U.S. equity markets could continue for quite some time. Ross Clark from CIBC Wood Gundy believes the greenback is on a strong attack while the Loonie shies back. We talk to Martin Armstrong right after this.
More and more people are looking to the internet for intelligent, riveting, and thought-provoking interviews. To advertise on the Goddard Report and TalkDigitalNetwork.com, call 604-699-8600, 604-699-8600. Welcome to This Week in Money, the source for market opinions. Here is Jim Goddard.
My guest is Martin Armstrong, CEO of Armstrong Economics. Welcome to This Week in Money, Martin.
Oh, well, thank you for inviting me.
Martin, starting off our show, your economic confidence model has a turning point September 3rd and 4th of this year. But before we even get into that, in your 2014 International Metals Outlook, you have a new report. It's very interesting. How can people acquire this report?
Well, they can go basically to our website. It's at armstrongeconomics.com. This report is rather significant in the sense that we've put together, for example, gold and silver in every currency. And people have to understand, I've been arguing all the time, a bull market is only when something is going up in all currencies. If it's going up in yours but down in everything else, you're going to be the buyer and they're going to be selling it to you. So it's very important to look at it from an international perspective, and we cover all the currencies plus a basket of currencies. And one of the things that I think is really kind of shocking to a lot of people that they don't pay attention, gold never even took out the 1980 high in Japanese yen. So, there are some very significant differences in its performance in various currencies. Now,
is there a cost involved with this report?
Well, this one is a very large report. It is probably more than 400 pages. I'm not even sure. It's covering gold, silver, platinum, palladium, and copper. This one is $400, and it covers it out till 2016. It provides the targets for the low, the price, and the timing. And then after that, where we should be going.
Now, in uncertain times, will money go to the U.S. dollar and or gold and silver? And why does it do that?
Well, primarily on an international level, there's a significant difference between precious metals per se, which are more for the individual, and internationally, capital flows among different markets from country to country. Historically, capital tries to flee away from any place that there is war, any uncertainty, etc. So, right now, we have complications going on with Russia, going on with Ukraine, etc. But Europe itself peaked in 2007, and honestly, it is in a death spiral. The socialism over there is so outrageous. It's the cost is just off the charts. And a simple coffee that at Starbucks is $5 here in the States. You go to Europe and it's 10. So there's just so many layers and layers of taxes. France, which was the second largest economy, its finance minister has had to admit, yeah, okay, fine, they're bankrupt. And all that's left, effectively, is really Germany, and Germany was counting on the euro to be able to have free trade and to be able to sell its goods, but everybody's declining. So, then with the Russian sanctions, German cars are dead as far as Russia's concerned. And now the sanctions against food, etc., like that, you're causing a tremendous amount of bankruptcies of farmers and things in Europe, all for U.S. policy.
Have sanctions ever really had an impact? Because it seems to me the leaders still have their caviar and limousines. It's the average person on the street who suffers, and I don't think if I'm deprived of food, I'm going to love America anymore.
No, exactly. And all it does is turn up the hatred. So the idea is that if they put on these sanctions, then the people will revolt and overthrow Putin. And they're not even really understanding what they're saying. I mean, in other words, you have to put these poor people through tremendous amount of stress and problems in order to get them to try and do a revolution. I mean, it's crazy, and it doesn't really work that way. And what has happened is it has boosted Putin's credibility, because then people feel sorry for him and say, yeah, it's the great Satan coming against us.
Your economic confidence model had a turning point September 3rd and 4th of this year. In hindsight, what did it see?
Basically, this is it's a minor turning point. This one, the major one, comes really next year. But from this point on, I mean, largely we're looking at the dollar just going up higher. We're looking at stock markets taking off in the United States still, with pushing to new highs. And this is capital inflows. I mean, if you look at the euro, it's making new lows. You've had a very interesting with the pound and the Scottish elections. You would think that, you know, everybody would have been buying the euro. Okay, fine, separatism's dead, but it's not. It's the economy's in absolute turmoil over there. And then you have what's going on in the Middle East. If this gets significantly worse, you're going to see more capital coming from the Middle East into the United States, from Dubai and places like that. And then in Asia, you have China and Japan rattling sabers at each other, and that gets more heated. You're going to see tons of money coming from Japan over here. So it just pushes the dollar up higher and higher and higher. And people, have to understand that the United States was actually bankrupt in 1896. That's when J.P. Morgan became famous and had to orchestrate a loan for the United States Treasury in gold to bail it out. So you had World War I and then World War II. By the end of those two wars, the United States had 76% of the entire world official gold reserves. And you went through a major sovereign debt crisis in 1931 where all of Europe permanently defaulted on its bonds, except for Britain. They went into a moratorium. Asia, China defaulted. South America defaulted for like the fourth time. So it ends up, really, if you have major institutional money, what do? And they've been moving into the United States largely just for security purposes. Then you have central banks. The problem with creating the euro was, yes, it created a single currency, but not a single government. And that was an absolute disaster. And so what's happened is that the euro is even second to the Chinese yuan as far as international trade is concerned. So what we're really looking at here is the fact that from a central bank reserve status, there is only one choice, and that is the dollar. You can't use yuan or yen or none of these other currencies can really step up and fill the shoes of the United States at this point. Yes, the United States has a $17 trillion debt. For that very reason, you can park money there. You can't park huge amounts of money in the British pound or Chinese yuan or Russian rubles or whatever. I mean, it's just not there. So, I mean, eventually you'll see, I think, the U.S. currency crack, but first we have to go up and make everybody's nose bleed, and then you'll see a turn.
Do you have any idea when the next downturn will happen in the U.S.?
We're looking at the economy will turn down from October of 2015, and the next decline looks like it's going to be even worse than the last one we went through between 07 to 09, and it's going to be much more volatile because we're having tremendous stress everywhere. The central banks have been forced into divestiture to some degree, and all they can do is hold dollars. So what they've been trying to do is to diversify, and you have central banks actually buying the stock market now. So private sector equities are becoming reserve quality for central banks. And if you add up all the reserves of the central banks and the wealth funds, you're nearly at $30 trillion. So even the U.S. national debt at 17 isn't enough to park the entire thing in.
What about real estate? They had a very strong new home sales over the past month in the U.S., much higher than expected. But can this real estate upturn be expected to continue for any time after now?
I would give it until about October of next year. What you have are several different problems. The Chinese have been the biggest ticket buyers. You have a tremendous amount of Chinese coming in, as you know, out there in Vancouver, of course, but they're coming into the U.S. market and buying the high ticket items. The Europeans have been coming in because of the fear of they're going to take 10% of anybody's accounts in Europe and the banks. The municipal governments in Germany, about more than 50% are technically in bankruptcy. So the German government is proposing to add a 5% tax to bail out the municipal governments. And they want to take 10% of everybody's account to pay out the banks. So it's getting to the point that, there's not much left in Europe. So you have a tremendous amount of capital coming this way. They're buying everything, property in New York, Florida, California. But again, they're buying more high ticket prices. It may be shocking to a lot of people, but the number one buyer of real estate in the United States, as far as the number of properties are concerned, are actually Canadians.
Well, I have a great trivia question for people all the time. What foreign country holds the most in the U.S.?
Holds? What do you mean?
Which country has the most holdings in the U.S. outside of Americans?
Oh, probably Canada.
Yeah, number one.
Yeah.
Yeah, just like the third country into outer space was Canada. Nobody remembers number 3, do they? Like they always say, Canada, the nation of bronze medalists. We turned that around in the Winter Olympics. So, how long do you think this downturn in American real estate, if it hits in October, next October, how long do you think it'll last?
It will probably go down pretty significantly for about 4 years, because what will happen in reverse is as people who have bought all the property in the United States as a hedge, as they need money, they're going to have to liquidate to have money to cover themselves. So that's the other side of the coin.
Again, for somebody looking for cheaper property and good investments in good areas, wait a while. You might find some really good bargains.
Yeah, I wouldn't say that the real high-end stuff is going to be a great deal, but for most of the Canadians are just buying second homes and things of that nature. I would stress to look more perhaps in Florida, because they have actually the best property laws. Nobody can take your house in a lawsuit or something like that. That's actually why O.J. Simpson bought his house over in Florida. But so it's Florida has some of the best laws for property, and the taxes aren't so crazy. The other state is Texas, but I would say there's probably a fairly large possibility that Texas may end up with a separatist movement within the next 5 to 6 years. About 35% of Texans right now would like to leave the United States.
Oh, they don't call them the Lone Star State for nothing.
Nope.
Always consult your investment professional before making any investment decision. This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back to This Week in Money. My guest is Martin Armstrong, CEO of Armstrong Economics. In 1989, your economic confidence model called the top in the Japanese stock market. At the time, the Japanese real estate market was at all-time highs. The Japanese were buying a lot of real estate at home, and especially here in North America. The belief at the time, Japan would become the world's next superpower. And now, let's take a look at what's happened in the last 20 years. Now, China is a real estate market. Its market is at all-time highs, and people there are thinking, well, perhaps are they going to buy up a lot of real estate in Canada, the U.S., and other countries? But it may be for different reasons. Maybe you could explain why China's push right now is different than what Japan did back in the late 80s, early 90s.
China is, being a former communist country, what's very interesting is that the people do not necessarily trust the government. So that's why they have been buying gold, etc. Not as, hedge against inflation and all this sort of stuff that they say here. It's just largely because they do not trust their former government. And whether they can go back to communism or whatever, the attitudes in these areas are substantially different. You look at Japan, they are more or less, they kind of stay in line, and they believe tremendously in their government because it was part of the original cult type thing where the emperor was God or the son of God. So I had a friend, we were at dinner one night and he was married to a Japanese girl, and the question was, gee, if the emperor said you had to turn in your husband who was British, would you do it? She's, oh, of course I'd have to. So he just looked at her and said, what? But that is the attitude in Japan. It's completely different than China.
So even though Japan is a democracy, they still look to the emperor for leadership.
More or less, it's they kind of have the tall, what is called the tall poppy syndrome. The one flower that grows taller than the rest gets its head chopped off. So they more or less stay in line, and they're very. I think the younger generation, you're going to see probably more of a revolution type thing eventually in Japan. But if
there are any younger people, their birth rate is horrendous.
Oh, yes. They even call it the celibacy syndrome because many of them don't even date.
And one of their biggest selling items are pillows that look like the opposite sex. And a village just celebrated the fact it had its first child in 40 years.
It's quite different in Japan, substantially different than people would ever imagine. But China is, on an attitude basis, completely opposite, really, of Japan. Much more entrepreneurship. That's why China has bloomed tremendously. And China, you have a lot of Chinese people willing to move because they have more self-confidence, whereas the Japanese tend to stay with themselves more isolationist.
What do you predict is going to happen now that there's this big difference between China and Japan? As you said, they're making noises at each other. Are we going to see a war between them, or is this just going to stay a war of words?
There is a very high support in China for payback against Japan, and there may be actually a conflict develop. I think particularly if you see something where the U.S. gets more entangled with Russia, etc., in the West and the Middle East, then I think you're going to see China assume that we're going to be really occupied and will not be able to defend Japan.
Is there any places where you can see a profit being made because of this conflict? Or is it the usual, just buy a lot of stocks in armory-related companies?
Well, the U.S. stock market may be the only game in town, because you have a tremendous amount of money around the world that has to park someplace. And it's not necessarily what's the greatest investment, it's what's the lesser of the two evils. So I think you're going to find that the stock market may actually continue up into like even 17, 18. And it's extremely resilient. And the interesting thing is that this is all capital moving. If we look at the statistics for the bullishness, you may see that on CNBC, but honestly, this is the point where retail or the individual participation in the U.S. stock market is at historic lows. So it's not anywhere close to a bubble that a lot of people are talking about. You can't have a bubble without everybody actually foaming at the mouth.
That's an interesting way to put the rumblings. There's rumblings also of election fraud in Scotland. The next referendum on separatism will be parts of Spain. You posted a quote from Stalin at ArmstrongEconomics.com. What was the quote, and where do Scotland, Spain, and the rest of Europe go from here?
Well, I think basically Stalin, his famous quote is that people who vote decide nothing. It's those who count that decide everything. So I think actually he got that right. And what we've been investigating in Scotland is just eye-opening. One, I think the entire election was rigged because they simply said those that could vote were only residents. So you had over 400,000 British living in England and living in Scotland that had a right to vote. And then the vote counters didn't even have to be Scottish. So I don't think that the Scots really stood a chance. And what you have to understand is this is not necessarily just a British issue. We have, I just posted largely about this whole problem with the EU, is that you have to understand is that the politicians have been desperately trying to create a federalized Europe. And that's what the euro was really about. And so what happens is that the failure of the euro, then that means all these people in Brussels, and there's tens and tens of thousands of them who are now working this, quasi-federalized government, would be out, on the street. So they're defending their own jobs. That's really what they're doing. And as a result, the way they have set this up, you can vote for a minister and he goes over there and he votes over there, okay, fine, in Brussels, whatever. His vote means nothing. The commission doesn't have to follow it. So you have effectively really a dictatorship. And the evidence has been coming out that they threatened in Greece when Greece wanted to put it to a referendum to see if they should accept this bailout. They said, if you put it to a referendum, there'll be no bailout. So they shut down the democratic process there. They've shut it down absolutely every place they possibly can. And I believe that they were also involved in Scotland. In Spain, they're going to take a vote on November 9th, I think it is. And effectively the EU there is basically, prompting Spain to say it's unconstitutional and we won't recognize anything that you vote on. In Italy, we published, quite an extensive amount of documentation showing that the EU Commission was engaged in a coup and got rid of Berlusconi, and because he wanted to take Italy out of the euro. Anybody who tries to leave is basically attacked. So it's really Europe has fallen into more of a fascist state. It's not democratic in the least. You can't even elect who's on the commission. That's all politicians who decide, the heads of Merkel, etc. You can vote all you want. She doesn't have to follow anything. So it's a very undemocratic process, and everything that we've accused Russia of is exactly what Europe has been doing.
And of course, as more evidence of this surfaces, you're going to have even more and more separatist movements.
You have separatist movements building everywhere, and the downside of this, by them trying to support their jobs and shutting down this, is largely just a dictatorship. That's it. So you're forcing these people into really eventually an armed conflict. And the idea of a single Europe was to defeat the possibility of a future war, that one government would then make sure that there's no war in Europe. But they're actually festering it. I mean, it's crazy. It's completely crazy, but you can't talk to these people that it's their way or no way.
The U.S. government, I'm sure, supports the status quo.
Yeah, I think we're going to see similar problems here in the United States. I mean, we published a survey which was quite shocking, but 25% of Americans nationwide already at this point feel that their state should secede from the United States. And that's 1 in 4. Wait till the economy turns down.
So all these people are saying, oh, conspiracy theorists, the government is stocking up on ammunition, buying millions of rounds, millions and millions, because they fear there's going to be unrest. These are actually going to become true?
Well, they do definitely know that they have problems economically. And, you know, where the hyperinflationist people are completely off the planet is that in order to go into hyperinflation, you have to assume government's going to make do, and honor all its debts. They're showing you that they have no intention of doing so. They keep chopping everything they possibly can. They're moving towards electronic currency. They're hunting everybody that has any money anywhere. And it's getting crazy. I mean, I've traveled my whole life. I just went over to Britain. I was at meetings in Brussels. And so I just jumped on the train to go over to London and check in at a hotel over there to get changed. So I still had a jacket and tie on, and I was the only person dressed on the train. And everybody else was tourists in shorts or whatever. I'm the one that gets pulled over. And I said, me? I mean, before, if you were business, they just, yeah, go ahead, go, because they figured you didn't have any t-shirts and trinkets and everything else. Now they don't care about that. They pulled me over. I said, here's my passport. It's American. I'm not British. They wanted to see where I bought my ticket. I said, I bought it in Brussels. I don't live here. I flew into Frankfurt, and I'm returning back to Frankfurt. And it was, oh, okay. You're just here for meetings? I said, yeah, that's it. They're looking for people with money. And that's what they're hunting. There was a guy that had $30 or $40 million in bonds in a briefcase in Italy, trying to make it on the train just to Switzerland. They came over, dressed in a suit and tie, grabbed his briefcase, and confiscated all the bonds in his briefcase. So this is what's going on.
Yes, in fact, I always dress up to travel just in the hopes I'll get bumped up to first class if they don't have enough seats in economy. It works, though. But I guess when you land, that's when the trouble starts.
Well, it's interesting because this is the first time it's starting to flip. And they're giving our people that come in from our Swiss office or wherever, why are you here? And they've been calling me on the phone. Do you really need them here? What is the problem? It's just crazy.
And here we thought they'd be spending all their time looking for possible terrorists.
No, the terrorists they don't care about, honestly. They're just looking for money these days.
Martin, where can people go to follow you and your thoughts on the internet?
ArmstrongEconomics.com.
Martin, thank you so much for being on This Week in Money.
Well, it's always a pleasure.
After the break, Ross Clark next on This Week in Money.
This Week in Money is archived online at talkdigitalnetwork.com.
My guest is Ross Clark, investment advisor at CIBC Wood Gundy. Welcome to This Week in Money, Ross.
Well, it's a pleasure to be back.
The U.S. dollar making headlines. It's gaining money, and we'll ask about the Loonie. But what is the U.S. dollar doing, and what do we expect it to continue to do?
Well, the dollar index has just been on a tear here since the 1st of July. I mean, the index is up about 7%. I mean, and for a currency, this is a very, very significant move. We've had moves of this magnitude, probably 4 or 5 times in the last 5 to 6 years. But each one of those has been driven back. But this one looks as though it's got the makings of something much different. And as people may recall, I've talked about longer-term cycles in the dollar. You tend to be 15 to 17 years in a cycle between putting in significant lows and significant highs. And the dollar, U.S. dollar bottomed out here. For all that everybody's been talking bearishly about the U.S. dollar, in reality, it bottomed 6.5 years ago. And this coiling that it's been doing in a tighter and tighter range for those last 6 years looks as though it's finally resolving to the upside. And this, for all that we're overbought right now, the type of strength that we're seeing, this persistence in the strength in the dollar, this money flow from Europe, the money flow from Japan, and the pulling back of U.S. funds, say, from Canada where investments had been made here. That type of action is what we saw coming out of the bottom in 1997 in the dollar. It's what we saw back in 1981, sort of part of that 15 to 17 year window that I'm talking about. And so for all that this move may have generated enough overbought readings that people are thinking it's going to come to an end very soon and it's going to fall right back out of bed, the reality is that we've seen this before. It's usually the kickoff to something much larger. So I'm expecting that if we can hold, it will probably go into a consolidation phase, whether it starts in the next week or two or whether it's a month from now. The key will be that as long as it doesn't give back more than 40% of this rally, and that's what we saw following those previous two breakouts, the consolidation phase that gives back a minor amount, starts to hold against the 20-week or the 50-week, and we'll call that a 200-day moving average. If it starts to hold against those, then you can be looking for the next big run in the dollar, and where the index has gone from, in round numbers, from 80 up to 85.5 in this last 3 months, you could look for a move that would be even larger in magnitude if the consolidation runs its course in a reasonable manner and gets ready to move. So what you've got is, an item that's going up. It's a classic bull market. It doesn't matter what you measure U.S. dollars in, whether you're measuring them against yen, Canadian dollars, the euro, against metals. You measure them against the gold price, the silver, any of the agricultural commodities. This is where the money is flowing to.
Why is the money flowing there?
Well, when you've got uncertainty such as you have in Europe regarding the strength of an economy, you've got the Japanese and Chinese bantering back and forth between each other. It's the safest haven, and it's where, in reality, over the years, so much money has been. It's your sovereign currency that's sitting there, and it is the one that the world turns to, especially when there is stress throughout the world. We saw that in 2008 when the equity markets came under dramatic pressure. You see that big move in the U.S. dollar. And what we're seeing now, I think, is something it's happening as more of a prolonged item rather than a knee-jerk such as we saw in September, October of 2008. This one's got legs to it.
What about the Canadian dollar?
Well, Canadian is what I call a classic bear market. From 2009 through 2013, the dollar came back and was trying to get through that 2007 high that it had up around 110 against the U.S. dollar. But it just didn't have much power in it. It tended to be a retest at a lower level and became a rolling top. And earlier this year, it broke through the support levels and had its first hard break into February. And the norm, I take a look at, like the NASDAQ top of 2000, or you take a look at the gold market back in 1980, 81. The type of rolling over here that we see in the Canadian is similar to those. And so the initial break that we had into February, the bounce back to 94 cents, and the subsequent erosion once again is just really, really lining up in the classic format. So from what I see at this point, as long as the bounces in the Canadian are shy of 91.5 to 92 cents, then the overall top plus that first leg in reaction would measure down to 85 cents. And I'm really happy with the price target on that one. It fits a lot of the technicals that I do. So in turn, that would fit in well with this quote strength in the U.S. dollar, which in turn is, putting weakness on commodity prices. And we are very, very much in Canada a resource-based currency.
Ross, I know you're more than just a pretty face. You do charts with us just about every week. And if we don't pay attention to you, of course, we end up paying the price. Can the average person actually use your skills to maybe help out their portfolio?
Well, what we do, my partner and I have been in the business for over 25 years as investment advisors here at CIBC Wood Gundy, and we are more than happy to sit down with individuals and take a look at their portfolios, put together something that will be appropriate for their age, their lifestyle, and the idea is to provide the best type of portfolio for that satisfies their particular needs.
And we'll have your contact information at the end of this show. More with Ross Clark next on This Week in Money.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back to This Week in Money. My guest is Ross Clark, investment advisor at CIBC Wood Gundy. Gold, bright and precious, hard to hold. What's that little shiny thing going to do for us?
Well, that little shiny thing's had pressure because of what's been going on in terms of that U.S. dollar. It's the reciprocal side of the coin. Actually, it's held up better than one would anticipate if it was a pure inverse relationship to the dollar index. With the dollar sitting at its highest levels in 4 or 5 years, gold still hasn't taken out the key support down at the 1188 to 1190 range. To look back, this year did have the makings of producing what I thought could be a significant bottom. We are in that 2.5 to 3 year window following the top. It's one of those time windows that you expect a market to be able to stabilize, trying to generate enough of new buying, and you hope that it has got to a valuation point that things can turn up. And through this year, we did have 3 really good rallies since the June of 2013 bottom. We got up to 1440 the first time, then 1390 and 1345 progressively, but each one of those came within a hair, within maybe $5-10 of what we were thinking would be resistances. And as long as the support in the 1260 to 1270 range had held through the summer, and we had been able to get back through 1320, that would have been, in my work, the catalyst for the run above 1400. And we had been seeing the mining stocks performing very well up until the early part of September. But with the violation of that support and the mining stocks starting to come under pressure, here we sit down in the 1215 range. And I think, we're going to have to form a whole new basis in terms of the analysis right now. On a intermediate basis, a few people have said, does this turn into a triple bottom? We got down here a year and a half ago, we got down here at Christmas, and here we are again. Does this support at 1190 or thereabouts, become a major bottom that we take off from? Well, I'd like to think so, but it's highly unusual for gold to do that. Gold likes to tease the investors when it goes down and tests for the third time. Typically comes within a few percent of the low, sometimes straddles a little bit underneath it, but invariably from there you get a rally, and I would suspect that we're pretty close to putting in an interim low and having a rally. But it will probably be capped in the 1285 to 1300 bracket, which would be around the 50-week or 200-day moving average. That's been the norm when I look back at it. So I think we've got, we have to put a whole new group of buyers in here, that will happen only after we've cleaned out some of the positions.
Taking a look at the equity markets, the S&P index once again just about a week and a half ago set new record highs. Are we warbling around near the top and it's going to go down? What's happening there?
Well, I think, once again, it's the inflows. If you take a look, the big cap names are really enjoying that flow of funds into the States. So that's why you see the S&P and the Dow hitting all-time highs a week ago. But if you take a look at the internals on it, you find that the advanced decline line, the New York Stock Exchange advanced decline line, during the September rally into the third week of September, the advanced decline failed to match the movement that was going on in the big cap names. And the small caps, the Russell 2000 group, it actually peaked in March, double topped against that in July, and put in a lower high in September. So this is indicative of a market that is, it's definitely a tale of two cities here. You've got the good and the poor ones in here. And the Russell 2000 looks as though it's probably in particular going to see continued weakness. When I look back, I find that part of the normal seasonal play that we've talked about, especially in the midterm election year, you look for that August through October window to provide an important low. Typical breaks are in the either grouped around a 10% break or around 20. So, but once you've had that low in place, the move from here, from whatever low you put in this next, I think within this next 4 to 8 weeks or so, the normal action from here has been a 20% move or more into the spring of the following year. So, I think we want to be prepped here that there's some vulnerability on the short term, but the objective of this year was to make sure that one found a way of positioning into that weakness, so that by the time we might turn the corner in November, December, and if we do spark to life at that point, a 20% move is the norm.
Ross, could you again maybe remind us about your contact info?
Well, I'm in Vancouver. The number here is 604-661-7759, or you can get me through an email at Ross, that's ROSS, .Clark, CLARK, at CIBC.ca.
Thanks a lot, Ross, for being our guest.
Always a pleasure.
And thank you, Martin Armstrong, also for being one of our guests. And thank you for listening. I'm Jim Goddard. We're back next week with more This Week in Money.
This Week in Money is a production of Howe Street Media Incorporated.